Hello and welcome to Rental Activities Part 2 of Chapter 4. Okay, I want to pick up on page 4.4 when they talk about rental in personal use. Okay, let's take a look at the first paragraph. It says, if the residence is rented for 15 days or more, and is used for personal purposes for more than 14 days or 10% of the days rented, whichever is greater. All right, the rental expenses are allowed only to the extent of rental income. Now, that's very important. Okay, in my previous video, I mentioned that number 1 on page 4.3 and number 3 on page 4.4 cannot cause a loss. Okay. So in other words, if you go to page 4.7 and you take a look at Schedule E and you look at line 26, that line cannot be a negative number. Okay? Only in number 2, where it's primarily a rental, can that be a negative number. Okay? So, again, read the examples in the book. All right? And like for example on page 4.4 at the bottom, okay, you have Glenn who rents his lake home for $2,500 for 20 days and uses it for personal purposes for 60 days. Okay, so that means his percentage of rental is 20 over 80 or 25%. His personal use percentage then would be the reciprocal, or 75%. So he has to claim all of the income, of course, okay, but then he only gets to deduct 25% of the real estate taxes and the mortgage. All right, that's always deducted first, and then the remainder would be deducted on Schedule A as an itemized deduction. Okay, then you get to deduct all the other costs like utilities and maintenance and things like that. Okay, and then if you still have a positive number like Glenn does with his balance of $550, okay, then you can subtract the depreciation. But the depreciation can only break even, all right? So even though Glenn had $3,000 of depreciation on this, he could only claim $550, all right, because he can't go below zero. All right, now I want to just give you all a quick tax tip, which is not mentioned in your book. All right, and you've got to do this, especially if you have clients and you're going to be, providing your services for a fee. Okay, I want you to think about this for a second. All right, go to page X and page XI in your book, the 1040. All right, we've mentioned several times that Schedule E, okay, is line 17. All right. Now, real estate and taxes normally for anybody would be an itemized deduction. And if you look at page 2 of the 1040, all right, you'll see that the itemized deductions are on line 40. Okay. Now, regardless of whether you take the deductions on Schedule E or you take them as an itemized deduction, assuming you can itemize, all right, your refund isn't going to change. Okay, it would still be the same. So no matter what you do, line 76A or line 78, which is the amount due, would basically be the same. Okay, assuming no other limitations. But there is a big difference if you can put it on line 17 of Form 1040, because in the state of Indiana, all right, the Indiana return starts with row 37, all right, which is AGI. So anytime you can take a deduction on page 1 of the 1040, all right, it'll also lower your Indiana tax. All right, so keep that in mind. No matter what you do for your client, try to get the deductions to go on the first page of the 1040 rather than on the second page of the 1040 as an itemized deduction. Okay? All right, that's just a little tax tip. Okay, So now we move on to page 4 or 5, where they talk about passive loss limitations. Now, I've already mentioned in the previous video, okay, it tells you right on there that a passive activity is a trade or business in which the taxpayer does not materially participate in most real estate activity. Okay, so real estate is a passive activity, even though any landlord will tell you that they work like heck, you know, on their rental properties. Okay, but it's still classified by the IRS as a passive activity. Okay, and it also defines at the bottom of page 4 or 5 the differences between active income and portfolio income and passive income, as we talked about in the latest video. All right, the what you should note, okay, you know, for quiz and test purposes and for just for good knowledge. All right, the paragraph underneath the example on page 4-6 is very, very important. Okay, normally passive losses can only be deducted against passive income. So if you don't have any other passive income on your return and you lost $5,000 on your rental, okay, normally you wouldn't be able to deduct any of that. Okay, you would have to, you know, push it to future tax returns when you would have some kind of passive income to write it off against. But real estate is a little bit different. Okay, and it tells you right on here, okay, if you read that whole paragraph, all right, if you are actively involved in the management of the rental property, and you obviously would have a material interest in it, of course, because you own the houses, all right, then you are allowed to deduct up to $25,000 a year in aggregate or total rental losses. Now that that loss gets reduced by 50 cents for every dollar that your adjusted gross income, okay, again, the bottom of page 1 or top of page 2 of the 1040, exceeds 100,000, okay? All right, and trust me, I will test you on this, all right, and it'll be on the quiz. This is one of my major areas that I like to put on a test, is rental property, because at least in our area here in South Bend, all right, there is a lot of rental property, and you will probably have a lot of clients that have this rental property. Okay, so, you know, look at the example in the middle of page 4-6. You have Mary has modified adjusted gross income of 120. She had a loss on her rental property of 18. She can only deduct 15,000. Okay, so what it is you look at her AGI, it's 120. You subtract the limitations of 100,000. That gives you $20,000 over. Take that times 50%. Okay, and that is 10,000. Subtract the 10,000 from the maximum allowed loss of 25,000, and Mary can only deduct $15,000 of her $18,000 loss. The other $3,000 is carried over indefinitely until you can use the loss on their return. Okay, now one other thing I want to mention on this video. At the very bottom of page 4-6, all right, in section 4-2A, they talk about if you do this as a trade or business. In other words, you're a landlord and you don't do anything else. You don't have another job or anything or anything else. So this is what we call a real estate professional. Don't forget those words, real estate professional. If you can classify yourself as a real estate professional, then your losses are unlimited. All right? Okay, so how do I know I'm a real estate professional? All right, look at the very bottom, page 4-6. It says if more than 50% of your personal service is performed in real property trades or business. Okay, so let's say, you know, I've had people come in and go, well, I have a full-time job. Can I be a real estate professional? And I'm like, no. All right, it would be almost impossible. because if you're working 40 hours a week at another job, that means you would have to work more than 40 hours a week on your rental property. That would mean you're working over 80 hours a week every week of the year. Okay, that's probably not going to work. All right, and the other one is that you have to perform more than 750 hours of service, all right, in the business, all right, per year. So there's 52 weeks a year, you know, so in those 52 weeks, you have to perform 750 hours of service on your property. Now, what constitutes service? Okay, well, most of the time that would be, you know, collecting the rent, making the repairs, things like that. All right, a few years ago, all right, I represented my client at an audit, and it was the only audit I ever lost, and it involved trying to get my client to be a real estate professional, and the IRS denied it because she recorded her hours going to the bank to put the deposits in the bank, and the IRS disallowed that, and she fell under the 750-hour rule that year, and therefore she wasn't a real estate professional. All right. Actually, it turned out in her favor because she was able to move the losses into another year, into a future year, where actually her combined income on the return was greater, and she actually got a bigger deduction than she would have had anyways. All right, but that is a real estate professional. Okay, all right. If you're just renting property, all right, and that's all you're doing, you would still use Schedule E and claim an unlimited loss. If you're in the business, though, of selling real estate, that's different, and that would go on a Schedule C. All right. You know, that you can go back and look in a prior chapter for. That ends this discussion of Part 2 of rental property.